Welcome back. Let's take a look at futures for a Wednesday morning. We got a mixed story. The Dow Industrials down 36. The Nasdaq is up 2. The S&P 500 lower by 3.25. We had a pretty good day yesterday. Markets closing higher with the Dow adding more than 300 points at 4 o'clock on Wall Street. Of course, ahead of today's Federal Reserve rate decision and commentary. The Dow Industrials, when all was said and done, up 320 points. It was almost 1%. The Nasdaq was up 63. That was about 1/3%. And the S&P 500 higher by 29 points, 0.5%. Interest rates, well, 10-year has been hovering around 4.3%. This morning it is down 1.1 basis points, setting a level of 4.28% on the 10-year. The Federal Reserve is widely expected to hold rates steady this month. At the end of this meeting today, we will hear from Federal Reserve Chairman Jay Powell at 2:30 p.m. Eastern after the meeting concludes at 2 o'clock. And perhaps we'll get some clarity on where the Fed is on rate cuts. Joining me right now is the Fitz-Gerald Group Principal, Keith Fitz-Gerald. Keith, great to see you. And this meeting, the Fed is in somewhat of a bind, according to Nick Timmeros, who was with us yesterday from the Wall Street Journal, because this last month of inflation readings were hotter than expected. So do you keep up the fight of inflation to take that inflation down with more rate hikes? Or do you do what the market is expecting, given the fact that you've already been successful in taking inflation way down and start cutting rates? What are you expecting?
That is an interesting question. I'm in the latter camp. The markets are forward-looking. The Fed, which always consists as data-driven and data-looking and diligent, is looking in the rearview mirror. So I would like to see them make some strategic decisions going forward, Maria.
Well, look, Rebecca, you heard from Christine Lagarde this morning from the European Central Bank, and I want you to talk about what you read from that. But first, here's Jim Grant, Grant's Interest Rate Observer founder, pardon me. He was with us last week, and he made a compelling comment to me when I asked him about the Fed's next path. Watch this. You're not expecting a cut in rates anytime soon.
No, they might decide that 3-ish is fine.
They might 3% inflation.
Yes, it's concern over the inflation rate and to focus on financial stability as they would define it. So, but however, I think there's also a chance, Maria, this year that the Fed raises if they are confronted with an accelerating rate of inflation. They might feel they have no choice. And who's to say that the 3.2% thing couldn't go up? We have an $80 oil price, no longer 70.
Wow, the Federal Reserve raising interest rates, that is certainly not a narrative priced into this market right now.
Not at all, but I will say, Maria, the thing about Lagarde's comments this morning that struck me, I watched them live, and basically she stated, even if, and it was said like this, even if we do agree to one rate cut, there is absolute no guarantee that there will be an additional subsequent rate cut. So it seems to me like they're getting very cautious, really pushing back against this worldwide pressure to lower rates. And I have to say, too, if we look at the Federal Reserve minutes that have come out so far, the fact that they state that they expect additional bank failures this year really indicates to me that they're expecting the almost $1 trillion of commercial real estate mortgages that have to be refinanced this year to have to actually be refinanced at higher rates, and therefore that's going to cause liquidity issues at obviously our small and medium-sized regional banks, and it will roll up because there's quite a large portfolio of CRE at the large banks as well. So they are expecting this, Maria, because I think that they're pricing and holding rates higher longer.
Keith, even yesterday when I spoke with Jeffrey Lacker, the former president of the Richmond Federal Reserve, he said, look, right now, the Fed is not as restrictive as these markets think they are. They're not. In other words, he suggested they could become more restrictive. So what do you want to do as an investor when you see that kind of commentary mixed in with the moves that we're seeing in, for example, the market and AI? Nvidia closed higher again yesterday. It unveiled its latest Blackwell AI chip during the annual AI conference. The CFO confirmed that the new chip will ship out this year, but the cost is more than people expected. It's going to cost more than $30,000 per unit. This stock is on fire, continues to do so. It's up better than 1% right now, Keith. So you say the AI bubble may be worse than the tech bubble of the 1990s.
No, it's totally different than the 1990s, you know. And so our advice to clients, we've been talking about this all week, all month with them, is now is the time where you focus on the best companies. You take a deep breath. We have a saying, when in doubt, zoom out. This is where you've got to make decisions as an investor. Forget what the Fed's going to do. Forget what about politics. Put your effort on the CEOs who are putting up good numbers, products the world can't live without, services they can't live without. Nvidia is a great example. We're going to have large customers. AI is in its infancy. They're buying every chip that company can make for the foreseeable future. It's dirt cheap compared to where it's going.
That's incredible. Dirt cheap. I mean, Adam, this stock is up 250% over the last year. And a lot of people compare this AI euphoria to what we saw in the dot-com era, which we all lived through, right? I asked Howard Lutnick about it.
Yeah.
And I basically put that question to him. He's the chairman and CEO of Keith Fitz-Gerald. And said, is the euphoria in Nvidia and in AI a bubble? Here's what he said.
Oh, good.
You don't have the
maybe
slide.
not.
He said, of course it's a bubble. He said, of course it's a bubble. But it's going to go on and on.
I wish he were here to basically go up against Keith and me, and I'll tell you why. In 2000, the NASDAQ was trading at 600 times. The price-to-earnings ratio was 600. Right now, by the way, the S&P 500 is trading at 21 times. And with regards to Nvidia, which you know I love, it trades at 30 times earnings. 30 times earnings growing 100%. Keith is right. Nvidia's cheap. I recently bought more.
You bought more because you sold it.
Yes,
you sold some
I
of
sold it too soon, so I bought it back. But you know, you have to admit when you're wrong. I sold it at $675. I bought it back at $875.
Oh, but you initially bought it at
$175.
Oh my God, $175. He bought Nvidia. How do you like that trade?
And he took the capital gain too. Wow.
Well, but here's the thing. There's three defining characteristics that people really need to think about. The 90s were driven by super high leverage companies you'd never heard of making products. Everybody remembers that talking sock commercial. And CEOs were in love with leverage. Now you've got large, very profitable, very successful companies leading the charge. The losses are limited to incubators. Nobody's ever heard of them for the most part. Aren't public anyway, so the public's not on the hook. And finally, leverage is a dirty word in the C-suite when it comes to excessive stuff. It's functional leverage now. So this is, again, a game that is just getting started.
All right, we will be watching it along the way. Keith, good to see you this morning. Thank you so much.
Thank you.
Keith Fitz-Gerald, and your morning mover this morning is a stock we've talked about in the